Hey everybody, welcome to another live Facebook, YouTube broadcast around the country, around the world, helping you with your tax and legal strategies and better living your American dream. Small business, investors, I'll do my best to answer your questions. Today's a Q&A, so rather than give our law firm or accounting firm a call or your own professional, hey, if we can answer it quickly here, I'm going to do again my best. So the time is yours. It is October 30th. My team wanted me to wear some sort of Halloween costume. I couldn't bring myself to do it. I've got to look somewhat legit, but I am going to ham it up, have a good time with you, and try to make learning the foundation of your business, the bookkeeping, the tax, the legal, the planning, so that you can build a huge building and empire. We got to have it. We got to talk it. You're the captain of your ship, so let's do it. First question is from Carol on Facebook, and she asked, how many board of advisors can you have on your LLC? Now, some of you may be going, I've never even heard of that concept. What do you mean board of advisors in an LLC? When I was clicking around on LegalZoom, I didn't see any board of advisors option. Well, at our law firm and most law firms that specialize in small business, when we set up your LLC or corporation, we want to have a board of advisors, much like a board of directors. The managers still run the business, the members own the LLC, and the board of advisors are there to give advice, to help advise, but it's a tax write-off, and that's the beauty of this. Now, you could use an LLC in two different ways. You might have an LLC taxed as an S-Corp, which is what we'd want on this side if you're doing operations, or you might have an LLC over here for your rental properties. In either situation, when we design the operating agreement, you have this board of advisors. I'll put BOA, Board of Advisors. Now, even though you're an LLC with a Board of Advisors and your company is Carpet Cleaning, LLC, then you've got this S-Corp election. That doesn't change the name of your company. You're still an S corporation. You're going to do the salary, dividend, pass-through split, and all this good stuff. But up here, this Board of Advisors is going to have annual meetings, which are a tax write-off for travel, meals that you might have, and it's a great way to build your business, to share your 10-year plan and the operations, your annual strategic plan, all that good stuff. I've got other videos on YouTube. Just type Kohler Board of Advisors. Great little video on that. And the answer is, Carol, as many as you want. You can have as many Board of Advisors as you want, but it only really makes sense for me to have 3 or 5. They could be nationwide, worldwide, and you fly to Italy to meet with your great uncle who's a real estate tycoon and he teaches you for a weekend and you fly back. That's a tax deductible trip because you're going to get tutored by someone on your board of advisors. Now, we're not going to abuse this. I want to make sure you have enough money in your business to justify this travel and dining and the things you might do with your board of advisors, but it's legitimate. It's a great business strategy. All right, next question. We got Roman.
Yes, Roman from YouTube. I have an LLC. Like idea to buy a car for my business. Would it be considered business use of the vehicle if I would just go to my work business place and back home? Thank you.
Okay, and I think Roman, we may have talked a little bit ago. I have this feeling, and that's okay. You got in here quick. I love it. Roman, this is a common question and a great one for many of our viewers today. I've got an entity and I want to write off a car, and we could put it in both of these situations. So here's my car for my operational business, or maybe for my rental property business. Now, let's even give it a better example. This could be a dentist. This could be the building where he rents out space to all sorts of other dentists. This could be a realtor, and she also has rental property. So let's use your realtor-renter example. So I have a realtor with a car. Now, does that LLC or S-Corp have to own the car in order to get a write-off? No. So everybody pay attention. Your LLC or S corporation does not have to buy the car in order to write it off. The IRS gave up on this issue years and years ago. All you have to do is be able to prove that you use this vehicle in business. So if I've got a realtor and she's driving all over and doing real estate stuff, and my daughter is taking the realtor exam here in 2 weeks. I'm so proud of her, Sydney. A little shout out for her. So while she's going to be out doing business as a realtor, all of those miles are going to be a write-off, or she may go actual. If you want to read a great article where I go through 7 ways or options to write off the car, go to my blog at markjkohler.com and go to the blog and search auto. I've got an article from January of this year giving you the best strategies for 2019. So I'll just say that again. Go below to www.markjkohler.com. Sign up for the newsletter while you're there. I do a weekly newsletter that's free. And go to the blog and type in auto. And great little article on that. But again, does my daughter Sydney's LLC or corporation have to buy the car in order to write it off? No. Now, Roman asks another twist here. He goes, well, I'm going to drive it to and from my place of business. Okay, do you have a W-2 job? Or what do you mean place of business? So if you're a dentist and you drive home at night and then you drive back to the dentist office during the morning every day, that's commuting. You're not going to be able to write that off. Now, when you drive around to other conferences or go pick up supplies or go out to lunch with other co-dentists, then you're going to be able to write that mileage off, or maybe even the vehicle itself as an actual expense. So whether you're a contractor, a developer, an engineer, a CPA attorney, dentist, a realtor, we're going to look at your non-commuting miles. Because if you go to the same place every day, the IRS is like, no way. Now, I know you may say, well, I have a home office, Mark. And so whenever I leave the home office, it's a write-off. Yeah, I'm okay with that, but not if you're going to the same workplace every day. You're going to have a hard time. So as an accountant, we want to be as aggressive as possible, but let's kind of rein it in. Now, if you have an LLC with rental property, can you still write off your auto expense, going to check on the rentals, work on the rentals, manage the rentals, talk to the tenants? Sure, but you're not going to run to the rental property every day, maybe not even every month, unless you got to go pick up rent or something. So your mileage deduction is going to be a little less here, but we're still going to take a deduction. So I may have the same car written off on both returns, or I may have a different car on each return. I may have a lease. I may have a purchase. So many options, right? So Roman, talk to your tax advisor. I think you're going to be having an appointment with one of our tax attorneys to do your year-end plan. Many of you, I recommend between now and the end of the year, have a checkup with your tax and legal advisor to do this situation. Okay, we got lots of questions, so I'm going to move quick. Okay, I'm going to do my best.
Herb from Facebook asks, about how much is your fee to complete a deed transfer, and who do we contact for the service?
Oh, thank you, Herb. The woman at our office, our paralegal, that's amazing for deed transfers. Let's say this LLC, you buy a property in your own name and you got to transfer it to the LLC. Don't worry about the due on sale clause. Never are they going to, I shouldn't say never. Once in like 10,000 deeds is the bank going to call this mortgage due because you did the transfer, or they'll just tell you to put it back. So once you buy a property in your own name because of the loan requirements, deed it to the LLC. In our office, the woman to talk to is Mallory. Mallory will hook you up, and you can just call our main number at 888-801-0010, and you can even email Mallory at KKOS Lawyers. The cost in most states, LAWYERS, KKOSlawyers.com, the cost is approximately $150 in most states. A few states, about 5 to 6 states, it's a little bit more. And then we don't do it in about 3 or 4 states because it's just a nightmare, and we have a referral we'll send you to locally to do that. Okay, thank you, Herb. Next question.
King Kong says, do I need to ask lender to put rental into an LLC?
No, King Kong, that's right on this topic. I'm glad you just brought that up. Don't go into your bank and go, hey, can I deed my property to my LLC? Just do it. Remember, you can't even ask the banker what the weather is outside, or they're going to go have to get 3 official opinions and call New York, the head office, right? I love bankers as people that I go fishing with or barbecue with, but I'm not going to go ask their permission every time I have an idea. So close on your loan. Get the property. They've already sold your loan to like 3 other. Transfer the deed. Now you get asset protection. The LLC collects the rent. The LLC pays the mortgage. The LLC pays the bills. Now you have asset protection. Bankers don't care about asset protection. They care about Fannie Mae and Freddie Mac. And if they're going to foreclose on you, they're going to come after you. And whether you transfer to the LLC or not, their rights are still good. You're not getting out of the mortgage just because you transfer to the LLC. What you're doing is protecting yourself from the tenants. So do it. It's great. We can help you out. Next question, Jen.
Jerry, sorry.
Oh, sorry.
I want to start a sewing business. I figure start with creating a label, then an LLC. Do I need to trademark my label? What is the process I should take?
Okay, and what kind of business?
A sewing.
Sewing business. And she has a label. And this is Sherry? Jerry. Sorry, Jerry. Okay. Jerry has a sewing business and a label that's his brand. Okay. Now I'm going to assume this isn't man, Jerry. I'm just going to go with Jerry as a guy, so forgive me. So the question is, should he trademark that image? And you can trademark an image or a name, and you would go through the Patent and Trademark Office. We charge $750. You get an hour with an attorney to guide you through the process, and then the filing fee is per designation in different industries. So Jerem Bergeson is our attorney. You want to work with Jerry. Jerem, J-A-R-O-M. Some call him Jerome, some call him Jerem, tomato. Talk to Jerem, and he would guide you through this trademark. We just held a podcast. Now, this is helpful because this is a big topic. We just held a podcast 3 weeks ago on iTunes and Stitcher titled Protecting Your Name, Likeness, and Image. And that's a whole radio show on trademarks. So I'd recommend you go listen to that. Now, the timing of the trademark and LLC is unique. Usually what I recommend for everybody out there is let's make sure you're even going to have a successful business, Jerry. And so I typically set up your LLC first. Let's get your website up. Let's get a bank account open, a merchant account. Get out there and sell a few clothes. Go down to the local flea market, sell a little bit on eBay, Etsy, I don't know. Make sure that you've got a viable brand and you're not going to waste your time. Because before I go spend $1,000 on a trademark, I want to make sure my business is really going to happen. So I'd set up an LLC, which can easily be converted to an S Corp. It could also add a partner. So this LLC can be morphed into a bunch of things. I might have 2 or 3 partners with their own S corporations. So we've got all sorts of options for structuring. But start with an LLC and get selling. If in the first month or 2 you're like, oh my gosh, everybody loves it. They love my brand. They love my clothes. This is a home run. Okay, now we want to talk trademark, because if it looks like you're going to go big, then we set up the trademark. And who owns the trademark? Not you, the LLC. So that's why I like the LLC first, because you're all the way down here. You might have an S Corp between you and the LLC. This might be your own LLC taxed as an S Corp, but the trademark is owned by the LLC. And then all your revenue comes in here, and we start saving taxes, getting protection, all those good things. So I would do LLC first, trademark second, get a consultation with Jerem. And even if you just book a half hour with Jerem and decide to not move forward, fine. Or he'll apply the half hour to the cost of the trademark. So check that out. Okay, we got Darnell.
Yes, Darnell asks, can you switch from actual to miles if your expenses are less and mileage is more?
Good question. So here's the problem, people. And I'll use my daughter, Sydney, as another example. She's a realtor, and she goes out and buys an SUV. Oh, this is a cool SUV. She puts a baggage rack on the top and lights on the front, and it's cool and tricked out. Well, if it's over 6,000 pounds, we may even go actual on that, right? We're going to take depreciation, bonus, 170, I mean, all this good stuff. It could be a huge write-off. And if she's making money, she might want to go actual. But then next year, she gets a day job. She didn't love being a realtor. Maybe she gets hitched and marries some wealthy guy. That's what we're hoping for. I'm just joking. And then she goes out and she's like, I'm not going to be a realtor as much. Can I switch to mileage? Because I'm not going to be on the road as much, but I'm still going to keep my license. Can't do it. Once you're actual, you can't switch to mileage. It goes with the car. Now, in my life once, I had 3 cars, my wife and I. We had a truck that was actual. I had a car that was a lease. And then we had my wife's car that we did mileage on. So you can use different methods on a tax return, but it goes with each car. And once you choose a method, you're stuck with that method for the life that you own that car. So go back to my article that I wrote in January and read up on that and figure out which car is best for you and which strategy. And people, I'm just going to say it now, be cheap, be careful. Being an entrepreneur is hard enough. rather than going out and buying a brand new BMW or Range Rover because you want to look cool. It's not worth it. Buy used, slightly used. Don't pay that cost of the new car smell and that depreciation when you pull off the lot. Be cautious. A penny saved is a penny earned. You're going to appreciate that advice someday. The more older I get, the cheaper I am. It's bad. It sucks. It's not good. Okay, next.
I am Will Reyes from YouTube says, I rent out my rooms out of my house and appreciate it like you would if you had multiple family property.
And
This is just put a question mark. Can I rent out the rooms out of my house?
okay, all right. So the question was, I am Will Reyes says, I've got a home that I also live in. So he is in this, say, 1/4 of the house, and that's where Will lives. And then he's going to rent out the other 3/4 of the house. We got lots of options here. You could treat it like a rental property, depreciate 3/4 of the house, and treat the other 1/4 as your primary residence. This part is not deductible because that's your home, your primary home. You might write off 1/4 of the mortgage interest on a Schedule A, but the other 3/4 is your rental property. Would you put it in an LLC? Probably not. Now, the goal with a situation like this for a lot of my clients is I want to get you out of here and make it a full-time rental as soon as possible. Then we pop it in an LLC and you're off to the races. Sometimes it's cheaper to rent somewhere and rent this out rather than live in that house. And you might be doing an Airbnb, a VRBO. There's lots of options here. So the answer is yes, you can do it. Some clients that own 3/4 of the home and just rent out a room once in a while, they don't even report that income. And sometimes the IRS is like, we don't care. It's not enough income to worry about. It's part of the Paperwork Reduction Act of it's not worth it. It's de minimis. So, but you don't want to be renting property under the table and get into problems with the IRS either. So meet with your accountant, Will, and see I would ask you, what are your plans? Do you have other rental properties? Where are you going with this? How much rent are you generating? Things like that are going to really help us carve out a situation particular to you. Okay, Nick.
Yeah, Anson Baker on Facebook asks, my business partner and I are starting a STR business. What structure do you suggest? We were thinking an LLC done by KKOS. Do we split the ownership or the entity? Thanks, Mark. Love your content.
Anson, thank you so much. Now, what Anson is really talking about is what I just mentioned, an Airbnb or VRBO. Now, a lot of people would think, okay, Mark, you put short-term real estate on the left, you put long-term real estate on the right. Now, hang with me, everybody. This is important. So if you're fixing and flipping property, wholesaling, maybe you're selling a product on eBay, you're doing a service, you have a landscaping business, we're going to be an S corporation sooner than later. That's where we want to be. If I'm going to hold a long-term rental, hold it more than 12 months, I'm going to be in an LLC and I'm going to put my rentals over here. Now, that's just review for many of you that follow my content. This makes sense. We got a firewall. I have passive income. I have ordinary income. I'm saving on self-employment tax. Over here, I'm creating passive income. Now we throw an Airbnb, a VRBO into the mix. Now on the face of it, you'd say, well, that's a short-term rental. That should go over here. But I don't want to put real estate in over here that I'm going to hold for the long run. The question is, how does the IRS approach this? The IRS has said, as long as you do not provide daily hotel services, concierge, turn down, daily cleaning, and act like a hotel. So if you don't act like a hotel and it's more than a 3-day rental or more, there's some different rules, there's 7-day rule, and there's a lot to study there. But the general rule, and most accountants agree, that as long as you're not acting like a hotel and they're week rentals or more, we're going to put them on the revocable living trust and make that the owner of the property. Now you may say, well, Mark, sometimes we rent a house from someone else that owns it, and then we turn around and VRBO it, kind of this short-term rent strategy. Well, that's okay. I still put it on this side. Now you can't depreciate it. You get to deduct the rent you pay and then collect the rent you make, and hopefully you have a good spread there. So anyway, I put all my VRBO and Airbnbs on this side of the equation. If you have something that's a little questionable, talk to your accountant, see where you want to go with that. All right, who we got?
Kalo from YouTube, should you transfer all the funds from operating company to holding company and have holding company own all small corporations for rental properties and be the major shareholder for the holding company?
You were so good, Kalo, until the very last of your question. So Kalo is generally right. Let's go through his or her question. Kalo said, well, should I take all my profits from my operational business and dump them into my holding companies for asset protection and for investment, right? I want to get my money working for me. This is my asset wealth building side. This is my operation side. So chances of a lawsuit are greater here if I'm fixing and flipping a property. So, what do I want to keep in this side? I recommend you keep enough operating capital to run the business and then drain the tank. Get it out of there. Let's use that money to make more wealth in an asset protected way. Fund a 401k, fund a Roth, fund my LLC and buy more rentals, buy precious metals, buy racehorses. I don't know, invest in what you know best, but let your business be the goose laying the golden egg. But don't take all the eggs and put them back in the business. Peel out the profit, let the business continue to work, and leave in the business what you need. Now, the last thing Kalo said that kind of threw me off is it sounded like Kalo alluded that this corporation would own this one. No. They're brother, sister. Down here, this is the Kohler trifecta. This is your revocable living trust. In fact, I'll do a new little picture here. This is getting a little ugly. This is a very, very common structure for so many of our clients. It looks like this. You have your revocable living trust, married or single, young or old. Always want to try to get a trust in there for privacy planning. This is your camouflage. Then we come up here and we set up LLCs. There's our vest for protection if a bullet comes flying in. The LLC owns the rentals. Over here's my IRAs, my 401ks, all of my preferred before and after tax planning. They may even have their own LLC. And then over here is my operational business. Or if I have my day job or my spouse has a day job, they're up here. Then here's my sole proprietorship that I'm going to graduate into an S corporation and maybe an LLC along the way. But this is my operations. It does not own this side. My trust or myself down here owns these two entities. Brother, sister. Peel the money out and inject it. Don't let the S Corp own this LLC. Not good. Very bad for tax planning. Julian.
Yes, Julian has kind of a two-part question here. He says, first time filing this year, should I go with S Corp? And then he says, what types of docs or info should I be gathering in prep of tax time?
Okay. This is a perfect question, Julian, for where we're at on this diagram. When does Julian change to an S Corp? Now, what I'm hoping is Julian's been an LLC all year. So that gives me flexibility to backdate it into an S Corp 1/1/19. See, if he had an LLC along the way, I can backdate it at any point. So let's just assume that for a minute. So Julian says, let's rephrase it. Hey, Mark, I've got my small business going this year. First time filing my small business. I've been an LLC all year. Should I backdate it into an S Corp and kick out a payroll the fourth quarter? The answer is really quite simple. Did you net more than $30,000 to $40,000? Now that's net. You may have brought in 60, spent 20 on expenses, and netted 40. I'm talking S Corp probably. I want to run the numbers. What state are you in? Find out if we've written off all the expenses you're going to get to write off and see what that net number is. If it's over 36 grand, we're probably going to do an S election, and the cost of doing the S Corp tax return is going to save you the cost of setting it up. Now, if Julian says, Mark, I wasn't an LLC all year. I was just out doing my biz. I don't have any structure. Well, too late for the S Corp probably. I'm not going to usually set up an S Corp in the last 2 months of the year unless you've already got significant income or need to open the doors. So I would just say, let's meet Julian and get you set up for 1/1/20 so you start the new year off right. be careful clicking on the web and going to some website and setting up your own entity. Get a consult. We charge $800 for a consultation with any of my attorneys to set up an entity in a state. And you talk with a real attorney for an hour building your diagram. People love it. Do it once a year, get your checkup, you're out there killing it. That's what we want to do. Okay, next question.
It says, if you buy down the rate for a mortgage that is over $750,000, can you deduct the fee that you pay from taxes?
So he said, okay, let's put Dave's point into perspective, his question. Under the new tax law, if, in this example, this is good, let's add this over to the mix. We'll put it in red. Dave is talking about his own home. Okay, nothing about the business. Dave's question is, I've got my personal home over here. And he's saying, I want to write off the mortgage interest. Now the new rule is, as of 1/1/18 and moving forward, if you buy a new home, you can only deduct the mortgage interest on a mortgage less than $750,000. If you have more mortgage than $750,000, you have to proportionally figure out what that interest is. You don't get a write-off. So you go to your Schedule A, and if you've got a $750,000 home, you're probably itemizing, which is A, and you're going to go over here and you're going to calculate the interest, 750 below and everything above. And the below is what you get to write off as an itemized deduction. Now, Dave throws us a curveball. He says, well, I'm going to pay down that mortgage. So it's right at 750, and then I can deduct all the interest. His first question is, do I get to write off that pay down? No, that's just more down payment on the house. And he said, well, there's fees. I don't know what you mean by fees. I would get a consult with your accountant on what you're talking about. The rule is, what's the mortgage interest on $750,000? If you're paying something down, now points are deductible if you paid points, and certain closing costs might be deductible. You have to go through the HUD statement. Your accountant will do that. But for the most part, you're just looking at interest and points. So that's what I would worry about here. And now let's just talk practically. Do I really want to put down another $100,000 on my house just to make sure I can write off the interest on it? I don't know if that's the best use of your money. Could I take that $100,000 and go buy a rental property and create cash flow? Because that $100,000 is just going to sit there in my house doing nothing. I'm not a big fan of having this huge amount of equity in your home. Now, I know Dave Ramsey's like, pay off your home as fast as you can. Okay, for a certain segment of our American public, that makes a lot of sense. Pay off your home, get out of debt, live on Social Security, and hopefully you have a 401k from work. Perfect. That's a great mix for a lot of people. But what about my business owners or someone that owns a home that's $750,000? Do I want that $750,000 just sitting there, making me no money at all? Couldn't I at least deploy $300,000 of it and make a 10% cap rate and generate $30,000 a year that would be in excess of the interest I would pay on that $300,000 by far? See, we've got to think economically here. Building wealth is different than the Dave Ramsey get out of debt and just sit there and collect retirement. There's a balance. So you might hear a little different story from me, and I love Dave Ramsey. He's changed my life too. I've been out of credit card debt for a while because of him. But we got to think about the long-term picture of building wealth too. Okay, next question.
Myra asks, question about short-term real estate flips. I know flips don't qualify for 1031 exchange, but curious if there's anything else to defer the gain from a sale of a property held less than 1 year. Property was not a rental, nor was it a primary residence.
So you're going to sell that property and dump it into another property that you plan on holding a little longer and do an opportunity zone strategy. And you may say, heard about it, Mark, doesn't work for me. I'm just saying. So research it. If any of you are thinking, man, Myra's question's a good one. I'm flipping homes over here. I can't 1031. Is there anything else? Opportunity zone could be an option. Number two, I'm going to get deep here. In a strategy like this, and I talk about this in my book, which I'm giving away today, I should say that. Anybody that shares this video, you get a free copy of the Tax and Legal Playbook. And tonight, or first thing in the morning, Rosalie is going to go through and look at all the shares of people that shared this and choose someone, usually a name that she thinks is really cool. I'm just joking. She's not that arbitrary. And she's going to just give away a book. And she will contact you and get your mailing address. And I will sign it right now. So thanks for listening. Thanks for watching. That's what I'll say. So this is a great book. You can get it on Amazon. And the Tax and Legal Playbook has the new tax law in it, 28 game-changing strategies, little independent chapters that I make fun and interesting. Last week's winner was Ronald Brittenbach. So congratulations. Ronald should have already received his book. Now, I talk about this strategy in the book, and that's the real estate professional classification. If you're flipping a lot of properties, one of the best ways to generate more write-offs against that income is to continue buying your rental properties. The more rental properties you buy, the more passive losses you have. And because you're in the business of flipping properties, that's why you can't do 1031 exchanges, these losses will help offset the income over here. A lot of times clients will go down and buy more rental properties and do cost segregation on these rentals that really sucks out a lot of great depreciation write-offs that you can use against the flips. Now, it's a deep concept. We may recommend that 1 out of 100 clients because you've got to qualify as a real estate professional, you've got to be acquiring active rentals, and you've got to have a tax bill that we're worried about. If those 3 things are happening, we're looking cost seg. Now, the third strategy, I'm going to blow your minds here, is the charitable remainder trust. So what I do is I have a lot of clients, they've got their RLT, they've got their rentals, they've got their day, operation here. Their spouse may have a W-2, you may be single, whatever. You got your home over here. And I set up a charitable remainder trust on the side. It's called a CRT. Ooh, that was ugly. CRT, Charitable Remainder Trust. Out on YouTube, you can type Kohler Charitable Trust, watch that video, and I've got a longer one in my tax and legal library for 30 minutes where I break this down. But basically, every once in a while, you take one of these flips and you transfer it to the CRT. You get a write-off for the fair market value of that property. And then it's sold and you don't pay any tax. And the money that goes in the CRT can generate tax-free cash flow for the first 5 years because of the deduction, and then it's going to create cash flow for the rest of your life. It's asset protected. It's a whole other topic. But you asked for the question. So I'm going to say 3 things: opportunity zone, cost segs, and a CRT. Deep info, do some research on it, set up a consult with my office if that would be helpful. Christian, is that Christian?
Christian, yes.
Okay. Okay, go ahead, Nick. What do you got?
Can you go over a strategy that will allow me to act as an insurance agent for my dad to roll his self-directed 401k money into a whole life policy?
So Christian said, is there a strategy to take a 401k and roll it into a whole life policy? I'm going to probably, and I hate to say this, I'm going to maybe make some people mad, and I'll probably lose some followers. So I'm going to talk about a very controversial point here. And Christian, you may know where this is going. And maybe Christian set me up to make me look bad. I don't know. I think I look good for a lot of people in this situation, but insurance agents that use this strategy don't like me. So I'm just going to say it. Be very, very careful of anybody that suggests you drain a retirement account with tax-preferred status and pay penalties, heaven forbid, or even taxes, so that you can fund a life insurance policy. Is life insurance bad? No. Technically, does whole life policies make sense when you can fund them and they can grow tax deferred and you can borrow against them? Sure. But they're a dessert strategy. After all you do, your bread and butter, basics, good business planning, Roth IRAs, 401ks, Roth 401ks, rental properties, my own home. I'm building retirement plans as well as college saving plans for my kids or myself. Insurance is an add-on, and term insurance is a must, but when do I add whole life? I'm just not a fan of whole life being the first choice, and certainly not draining retirement accounts to do it. And I'm probably going to get some hate mail for that, but I've done it. I've paid for whole life insurance, and then when I had a down year, I couldn't pay the premium. What happened to the policy? Gone. Oh, but Mark, you can do single premium. You'll not have to ever worry about it again. Oh yeah, I've been down that route too in my family. 15 years ago, we did a single premium. It's died. Right now, died. It's not a guarantee that that cash value will cover the premiums forever. Call my mom up, talk to her about it. It is a very technical strategy, and you should get a second and third opinion before you just drain retirement accounts to do whole life insurance. I'm not saying it's bad. I'm not saying that insurance is bad, but draining retirement to do it, I just am not a fan. So I'm sorry, Christian. Send the hate mail to mark@markjkohler.com, and I'll put it in my trash folder. I'm just joking. Okay, all right. Couple more questions.
Vinkata on Facebook asks, I have an S-Corp and planning to dissolve it. How much time do I have to close all the bank accounts and associated credit cards after dissolving the firm?
Ooh, wow. So Venkata's over here saying, I'm going to close this down. And since she's asking this question, or Venkata, 12/31/19, that's what I'm presuming. The problem is, Venkata, when you close down the company and then there's any money in the bank account, what happens if you earn interest? What happens if someone pays you something after January 1st? You got another year of tax reporting. You may close down the company with the state and file a final tax return, you think, and then some income sneaks through the door in January. So I would prefer you start now closing everything down, bank accounts, distributing assets, and you're going to work with your accountant on this process to make sure the tax ramifications are considered. But if you're going to close this bad boy down, get it done as soon as possible, because you want to make sure there's no tail whipping around in 2020. So you want to try to get everything closed you can by 12/31/19 so that you can then file a final tax return. So I kind of changed your question there, because you asked, well, how long after I close it do I have to do this other stuff? Well, doing that other stuff is really closing it. So you've got to go through those steps and then it closes. I think you've got the cart before the horse a little bit. So talk to your accountant about the procedure. Pedro
from YouTube. What is step 1 for creating a holdings company? And then how many LLCs can be put under it?
Okay, so Pedro, here, we could even use this example here, says holding company. Now, first of all, everybody, when you buy your first rental property, the LLC you create for that first little rental is considered a holding company. I would call it that. It's a holding company LLC. What Pedro's referring to is kind of a parent holding company. That's what I call it, Pedro. And I think if you talk to tax or legal advisors, you want to use that terminology. What Pedro's saying is, hey, I got a bunch of rentals, and this is the only time I would implement this for a client. There's companies out there, literally, and I could say their name now, but I might get sued, that are going to sell an elaborate package out of Nevada or Utah, and they're going to have a bunch of LLCs, but for lifetime, they'll set up as many LLCs as you want and charge you thousands of dollars for this asset protection bulletproof plan. Get a second opinion if you're hearing any of that verbiage. So Pedro, before I even explain this, I'm not even going to go down this path unless you've got at least 10 rentals, maybe in 2 or 3 states, and you're worth $1 million, because it's not necessary unless because we do what's best for our client. Now let's just assume Pedro's making that type of bank. What we would do is set up a holding parent LLC, typically in Wyoming. I've got more privacy strategies. It's cheaper. I'm not going to go to Nevada. Probably stay away from Utah too. Wyoming's got great rules here. I can hide you for at least a year or more. No one even knows you own this LLC, but your trust owns it. This is a parent LLC for all of your other LLCs. And now I may have an LLC in Arizona, an LLC in Michigan, and a Florida LLC. And I've got my rentals out here, and I'm worth $1 million, and I want this 2-layer protection. That's why Pedro's doing it. I also get better tax audit protection. I can be more effective in my asset protection plan. And my wealthy clients, Pedro, this is where we go. But just don't do it right out of the gate if you only have 1 or 2 rentals. It's not worth it. And we're pretty affordable here too. We'll usually do the first LLC for $800 and knock a couple $100 off these if we're doing it all at once. If you've got partners, it's going to cost more. If you have IRAs or 401ks in the mix, it'll cost a little more, but it can be very affordable. So be careful there. Don't overdo it. That's the moral of the story there. Well, anyway, 45 minutes, a couple important announcements. Remember to share the video so you can win this book. Also, I'll be in Philadelphia this Saturday. Maybe a couple more seats available, but you got to call tomorrow to the office to probably register. Philadelphia will be from 9 to 4 o'clock. There's a Flyers game on Saturday night and an Eagles game on Sunday. Make it a tax write-off. Come to town, baby. Come see me on Saturday in Philadelphia for my annual Business Owners Workshop. I'll be in Hawaii on the 23rd of this month, well, November. We're going to be in November soon. And if you want to come over to Hawaii for the weekend, that's the Saturday before Thanksgiving. And then I will be in Orange County and a live broadcast for all of you. You don't have to go anywhere. You can sit on your couch for $99 and watch a full day workshop with Q&A at different times throughout the day for $99. So get over to my website, markjkohler.com, and sign up for the live broadcast on December 7th. If you want to come in person, we're going to probably sell out as well, but it's in Orange County. And guys, my workshop's $200. I have an early bird special still this weekend finishing up in Hawaii, $50 off. So I try to make it very affordable. Remember, I'm cheap. And if I'm not the type of guy that does a mastermind workbook group in Vegas for $3,000 or $20,000 if you want to meet me on my private island. None of that garbage. $200, come learn the basics. You're going to love it. I don't know. We have a 401k special next month. Make sure you sign up for the newsletter and no live stream next week. I don't know why, but I'm going to follow Rosalie's lead on that. And so, okay, so we'll see you guys in a couple weeks. Live stream. Thanks, everyone. Have a great night. Great Halloween.